Today, we will talk about how to start investing with just $100. Investing may seem intimidating, especially if you have only a small amount of money to work with. But the truth is, with as little as $100, you can begin building your financial future and start experiencing the benefits of long-term wealth accumulation. The key lies in understanding the options available to you and using your money in a strategic way. Even with a modest starting point, you can make your $100 work for you and set the foundation for future investment growth. Understanding the basics of investing. Before diving into the different investment opportunities, it's crucial to understand some basic principles of investing. Investment by nature involves putting your money into assets with the expectation that they will grow over time. The fundamental goal of investing is to generate returns that outpace inflation and provide you with more purchasing power in the future. One of the most important concepts in investing is the relationship between risk and reward. Higher potential returns generally come with higher risk. As you look at different investment options, it's important to assess your own risk tolerance. How much risk are you willing to take on in exchange for potential rewards? Compounding is another powerful concept to understand. When you reinvest earnings, whether in the form of dividends, interest, or capital gains, they begin to generate additional earnings. Over time, this compounding effect can dramatically grow your wealth. Even small investments can snowball into larger sums as long as they're given time to grow. Lastly, diversification is key. Spreading your investment across different assets, such as stocks, bonds, and real estate, helps mitigate the risks associated with any one asset class. Diversification allows you to balance the highs and lows of various investments to smooth out potential market fluctuations. Setting your investment goals. Before you start investing your $100, it's important to take some time to think about your personal financial goals. Setting clear and realistic goals will help guide your investment strategy and ensure that you're making decisions aligned with your objectives. Start by determining your time horizon. Do you want to invest for the short term, perhaps to meet a goal within a year or two? Or are you looking to invest for the long term, such as for retirement or a child's education? The longer your time horizon, the more risk you can afford to take on because you have more time to ride out the ups and downs of the market. Next, consider your risk tolerance. Are you comfortable with volatility and potential short-term losses in exchange for the chance of greater long-term gains? Or would you prefer a more stable and predictable investment, even if it means slower growth? Your risk tolerance will influence the types of investments you choose. Lastly, decide whether your focus is on income generation or capital growth. Some investments, like dividend stocks or bonds, pay regular income, which can be appealing if you're looking for passive income. On the other hand, if you're looking for growth, you might prioritize assets that have the potential to appreciate in value over time. Investment options for beginners with $100. With just $100, there are a variety of investment options that allow you to get started without needing significant capital upfront. Let's explore some of the most common ways you can invest that amount of money. Stocks and ETFs. One of the most popular investment vehicles is buying individual stocks or exchange-traded funds, ETFs. Both options provide the potential for significant growth, though they come with varying levels of risk. With just $100, investing in individual stocks might seem out of reach, but many modern investing platforms allow you to purchase fractional shares. Fractional shares allow you to buy a portion of a stock rather than a full share, which makes high-priced stocks more accessible. For instance, if a stock costs $1,000 per share, you could invest in a fraction of it, perhaps $50 worth, without needing to buy the whole thing. ETFs, on the other hand, provide a great way to diversify your portfolio with small amounts of capital. An ETF is a collection of different stocks or bonds grouped together into a single investment. By buying an ETF, you gain exposure to a wide range of companies or industries, reducing the risk of putting all your money into one stock. Many ETFs track major indices like the S&P 500, which means you're investing in a broad swath of the U.S. economy. This diversification makes ETFs a solid choice for beginners who want to minimize risk while still participating in the market's growth. Robo-advisors. If you're new to investing and want a hands-off approach, robo-advisors can be a great way to get started. These automated investment platforms take your financial goals and risk tolerance into account and create a diversified portfolio for you. Platforms like Betterment, Wealthfront, and SoFi allow you to start investing with as little as $100. Robo-advisors typically offer a range of investment options, including stocks, bonds, and ETFs, all managed in a portfolio that's automatically rebalanced as market conditions change. Robo-advisors charge low fees and can help you build a diversified portfolio without requiring you to pick individual investments yourself. Cryptocurrency. Cryptocurrency has gained popularity in recent years as an alternative investment option. With just $100, you can invest in fractional amounts of various cryptocurrencies, such as Bitcoin, Ethereum, or newer altcoins. Crypto markets are highly volatile, meaning the potential for significant gains or losses exists in a short period. For a beginner, it's important to approach cryptocurrency with caution and only invest what you can afford to lose. However, for those interested in exploring the digital currency space, platforms like Coinbase allow you to start with small amounts of capital. Managing risk and staying consistent. With any investment, there is inherent risk, but with a thoughtful approach, you can manage that risk effectively. One of the best ways to manage risk is to diversify your investments. Don't put all your $100 into one stock or asset. Instead, spread it across different types of investments, such as a mix of stocks, ETFs, and savings accounts. This will help reduce the impact of any one investment underperforming. This approach helps smooth out the impact of market fluctuations, as you're buying more shares when prices are low and fewer when prices are high. What do you think of our video? Let me know in the comments section below. Also, subscribe to our channel before you go. Thanks for watching.